September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it straight. These things are going to happen. And that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one.
Jim Rickards, author of The Road to Ruin, the global elite's secret plan for the next financial crisis, believes that the next economic crash will happen in 2023. He believes that most people will lose their homes and jobs and that the economy will be in a downward spiral for years to come. Rickards is a respected financial analyst, and his predictions should be taken seriously. If his predictions are correct, then we need to start preparing now for the coming economic crisis. In the 2008 financial crisis, nearly 9 million Americans lost their jobs, and another 11 million could not meet their mortgage payments, with unemployment in the United States reaching a peak of 10% in late 2009, according to a 2018 post by popular news media Marketplace. Millions of homeowners also lost their homes due to foreclosure. All these events led to the worst economic crash since 1929. The world has not yet fully recovered from that recession. If we look at the recent trends in the housing market, a new housing bubble is forming, which will almost certainly lead to another crisis in 5 years. This time around, it will be even worse than before. What exactly do we mean by that? Listen on to find out. In this video, we will reveal why Jim Rickards believes the 2023 economic crash will make most people lose their homes and jobs. Please watch, like, and share this video. Also, drop your comments and thoughts below, and don't forget to subscribe to the channel for more related content similar to this. We begin with a short clip of Jim Rickards.
The thing about labor force participation is a very simple calculation. You say how many people are working, that's the numerator, and how big is the labor force, that's the denominator. That's all it is. Now, it's never 100%, right? Because there are students and homemakers and retirees and others. There are good reasons for some people not to be in the workforce at any given time. But as recently as 2000, that number was 70%. What drove it between approximately 1975 and 2000 was basically women entering the workforce, women who had been home, as homemakers or performing other roles, entered the workforce, and then that number went up. So like I said, it's never 100, but 70 was very strong. 62 is down a lot. I mean, that's about a 14% decline. Look, GDP, the standard definition is, it's consumption plus investment plus net exports plus, government expenditure, like a 4-part thing. Yeah, but there's a simpler way to do it, which is how many people are working, how productive are they? Just who's working and how productive are they? That equals nominal GDP. And if you have fewer people working, the economy is going to shrink unless productivity is going up, which it's not. And so this is one of the major headwinds. Now, you're right, there are some early retirees. There were a lot of people who stayed home, obviously, during COVID, and just it's very well studied and clear that working is a habit, it's a good habit, I think, for the most part, but it's like any habit. Once you break it, it's hard to go back. So once you get used to not working or working from home or, we're just staying home, the government was handing out checks, beginning with Trump in, I believe it was June 2020. Everybody got that one was a $1,400 check. And then in December 2020, at the end of the Trump administration, everybody got a $600 check. And Biden comes in February 2021, not to be outdone, he hands out, I think, a $1,600 check. So everybody got a check, like 2 or 3 of them. And a lot of younger people opened accounts on Robinhood and started trading Bitcoin. That didn't work out too well, but a lot of people saved the money. But there were very definite spikes in retail sales coming within 30 days of the checks. Well, that's not surprising. I give people free money, they'll go buy stuff. And that kind of kept the economy going. It wasn't a real boom, but it looked good. But we're not doing that anymore. There's no more checks. And so you had a lot of people who lost the habit, a lot of people staying home, watching, maybe the World Series or whatever, eating Doritos, but they're not working. A lot of people out of the habit, but they just got used to government handouts. Not everybody.
Rickards cites that the number of workforce in the United States has reduced drastically, with lots of people staying at home with no work to do. An October post by the Washington Post revealed that United States workers have gotten way less productive, and no one is sure why such is happening. North Bay Business Journal also revealed that according to data from the Bureau of Labor Statistics, productivity, which is the measure of how much output in goods and services an employee can produce in an hour, plunged by the sharpest rate on record going back to 1947 in Q1 of 2022. Just recently, Reuters also revealed that Meta cuts 11,000 jobs as it sinks more money into the metaverse. All of these happening are only proving Jim Rickards' statement about a potential economic crash fallout and people losing their homes and jobs. The economic crisis of 2008 left many people reeling. Unemployment soared, stock prices plunged, and real estate values fell by double digits in many areas. It was a difficult time for most Americans. But the upcoming economic crash in 2023 will be much worse. Listen to these carefully.
The other problem is, because people say, wait a second, how can you have low labor force participation when everywhere you look, there are help wanted signs, which there are. I mean, McDonald's is paying $35,000 for an entry level like cashier or hamburger, maker with benefits, training, and advancement. Well, that's pretty good for entry level hamburger person. So there are and people call this a labor shortage. There isn't actually a labor shortage because we just talked about how you've got perhaps as many as 10 million people between the ages of 25 and 54 who are sitting home. But the problem from the employer's point of view, there's a shortage of willing workers, but willing workers. Well, what makes you willing to work? Well, a raise, a good pay is one. As employers can't afford to pay the clearing wage to get people off the couch because they'll go bankrupt themselves. They're working on very small margins. Sales are declining, et cetera. So I'll pay as much as I can to get the workers, but it's not enough to get this person off the couch, so to speak. And so you've got this really weird situation. I use weird in the technical sense, where you have a huge pool of able-bodied, potential workers, but a shortage of willing workers because you can't pay a clearing wage. But that's more a reflection of how stressed businesses and how low margins are. And then you look at the big names. I mean, I guess Twitter is the most recent, but Amazon, FedEx, Target, they're all looking at big layoffs, and there are announcements coming every day. So none of which is good for the U.S. economy. But the Fed looks at unemployment. I mean, I look at it because you're supposed to know what it is. I mean, I always say, if you're trying to forecast the Fed, you got to look at the world the way they do, even if it's messed up. Like even if they're looking at the wrong things, which they are, as an analyst, you have to look at them to figure out what they're doing. That's how you do intelligence work. Think like the other guy. But then once I take my Fed hat off and say, well, what do I think? The unemployment rate is almost irrelevant. First, that's a lagging indicator. Secondly, it ignores what we talked about with labor force participation. There is no Phillips curve. I mean, you can draw one. Last time I saw a Phillips curve was flat. Or I went to school, curves weren't flat. But that's but they're just looking at the wrong indicators. I mean, the recession is coming, but and Jay Powell said this. I mean, Jay Powell gave two speeches, August 26th at Jackson Hole and September 21st after a press conference after the FOMC meeting that day. And the September 21st speech was almost like, well, just in case you weren't listening to me in Jackson Hole, let me tell you again what's happening. And he was in Jackson Hole. He was like Nancy Pelosi. He tore up a speech and wrote a new one, like literally the day before. 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain.
The 2020s are going to be a turbulent decade for the world economy. The post-war liberal economic order is breaking down, and there's no consensus on how to rebuild it. Longer term, the global economy's challenges will only intensify in the coming decades. What we're witnessing right now is a transition from one era of history to another. Some might call this the end of capitalism, as we know it. But whatever you call it, the change underway is profound and permanent. Listen to these carefully.
The Fed has this dual mandate, which never made sense, but it's the law. I mean, Humphrey Hawkins. So the dual mandate is price stability and low unemployment. Okay. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from 3 point, I think it's a 3.5, 3.6 at the moment. If it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever, QE3. So they're willing to do that. And they also think the recession, if it comes, will be mild. But those two things together will get inflation under control. And what Powell said, he didn't say that their target is core PCE, personal consumption expenditure, price index, core meaning excluding food and energy. And everyone's like, why would you exclude food and energy? Again, I'm not here to debate it. That's what they do. So if you want to think like a Fed head, that's what they do. Okay. They want to get core PCE year over year to 2%. It just came in at 5.2, which was up from August. So September was 5.2. August was about 4.7, give or take. Pardon me. It just went up. I mean, it's not going down. But they're trying to get it down. Now Powell did not say we're going to raise rates until core PC is 2%. He didn't say that. What he said was we're going to raise rates until it's acting in a restrictive way on inflation, and inflation will come down on its own because rates will be high enough to cause that. Mm-hmm. At which point we the Fed will pause. And you say, well, when are you going to cut rates? He was like, the pause could be a year. You're talking, forget this Fed pivot nonsense. I mean, you're talking 2024, if then.
2023 shaped up to be a big year for the economy. After a few years of slow growth from the COVID-19 pandemic, many experts predicted that the economy would finally rebound in a big way. Unfortunately, this rebound was short-lived, as it is being fueled by unsustainable practices that could eventually now lead to an economic crash. The most likely cause of this crash is the increasing levels of debt that both individuals and governments are taking on. This debt can only be sustained for so long before it becomes too much to handle, and when it does, the economy will come crashing down. Another factor that could contribute to the crash is the current housing market bubble. This bubble is being driven by low interest rates and easy credit, and it is not sustainable in the long term. When it finally bursts, it will cause a lot of pain for those who have invested in the housing market. Listen to these carefully.
So they've got to get rates high enough. So they're going to go, 75 basis points in November. December, who knows? We'll know closer to the date. It'll either be 50 or 75. Some talk about 50, but it doesn't matter. I mean, it's going up. Probably going to go up. I have the calendar for 2023. There's a meeting February 1st and another one in late March, I think March 22nd. They'll probably raise up both of those. They're going to get rates up to five-ish. At that point, they probably will have achieved the goal of bringing core PCE down, but they will also have destroyed the economy in the process. It's like I remember in Vietnam, the old saying, we had to destroy the village to save it. Yeah. We have to destroy the economy to save it. This is the latest in a long string of Fed blunders since 1913. Seems to be their specialty, but that's what they're doing. Yeah, they could at least pause now, or maybe even cut rates. If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield of maturity below what the Fed will give you for a phone call. I mean, all those things are happening. That's hard data, and it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff.
Right.
So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all?
In the darkest moments of the Great Depression, a beacon of hope emerged. Homeownership was one such light in a time of darkness. In fact, back then, owning your own home was marketed as an unbreakable asset that could help you squirrel away wealth for a more comfortable future. But today, housing is seen as a millstone around the necks of millennials, leaving many unable to afford the cost of living and propping up renting for longer than ever before. This has led some to suggest that another Great Depression-like crash is on its way, but what does the data say? Are we at risk of another economic crash? Feel free to let us know your thoughts in the comments section below. Kindly share this video with your family and friends, and don't forget to hit the like button and subscribe to our channel for more updates. Thanks for watching.